Hello, class. This week we're going to study money and monetary policy. Why do we use money today? The reason we do is because we used to barter, which is when we would just trade items for what we were looking for, and it took a lot of time and a lot of effort to find somebody that had what you were looking for to trade, and they wanted what you had. And so, how much money is available affects our ability to purchase goods and services. And so, we need to make sure we have plenty of money available. And how we determine what money is available is from our Federal Reserve. I'm sure you've heard of the Federal Reserve, but they're in charge of our money supply, and they use three different tools, and these are used to create what they call monetary policy. There are reserve requirements, discount rates, and open market operations. I'm going to go over each one with you, give you kind of a working knowledge so that you have something to take with you. Our reserve requirements I'll go over first. Basically, all banks have to keep money in reserve, so that way there can't be a bank run or something like that. And if they change the reserve requirements, the Fed can alter this lending capacity. They can let you lend out more, and this would stimulate the multiplier. And so there would be more loans going out, and we can stimulate demand that way. And so if they change those, that's how they can create. Another way is through our discount rate. These banks will earn their income by making loans. If they cannot satisfy their reserve requirement, which is what they're required to keep in the bank so that it prevents a bank run, they can borrow money overnight from another bank and pay either the federal funds rate or the discount rate. And the Federal Reserve sets up these rates, and so that way they can control. If the rates are really high, these banks are not going to want to end up borrowing money. So they're going to be pretty careful with what they're loaning. They're going to loan less. And so that's why we're pretty careful with those and knowing what those rates are. If the discount rate is raised, borrowing reserve becomes more expensive and fewer reserves are borrowed. This will decrease the money supply. It's going to do this the same way with you and me. We're not likely to borrow money if the interest rate is quite high. And so that's why we look at these rates, because they really help us determine what our rates for loans look like. The third one is our open market operations. If we move our money from savings to bonds, our reserves are going to fall. And so we're going to look at this. When the Fed buys government bonds from the public, reserves increase and more loans can be made, and our money supply grows. Anytime that money supply grows, our demand is going to grow, and so that's going to help us to spend more money, help the suppliers of those goods to be able to hire more people so that they can make money as well. The Fed can induce people to buy bonds by offering to sell them at a lower price. The more that they can buy, the more money supply will grow. The federal funds rate is really the big takeaway I want you to have here. It's basically the interest rate that one bank charges another for an overnight excess reserves. If it increases reserves by buying bonds, the federal funds rate falls, and vice versa. This is really their very visible signal of what's going on when they have a meeting. That's what everyone working in investments is looking at to see if that federal funds rate is going to stay the same or change. They use it as their primary barometer at this point. And it's interesting to see how closely and how impactful that is. If you look at our rate, it is so low right now. And it's just interesting to see for such a long period of time that it has been low. The Federal Open Market Committee, they meet several times a year. The bottom is a website you can go to, and you can read minutes from their meetings. They're also on C-SPAN. I joke that they're good to see if you're struggling to sleep, but they really are quite interesting. You can see kind of where they're going with things It also will really help you understand. They do a really good job of explaining things because when they're in there, a lot of times they're testifying before like Congress, and so they don't have a great economic background in many cases. So they really go through a lot of details, and so it really helps you to understand more about the Federal Reserve and more about monetary policy in general. The words I shared with you were kind of big, but in general, they're pretty easy to understand the basics of. If you have questions, let me know. I got my information from Brad Schiller's Macroeconomy Today. Have a great week.